Hello, class, and welcome to our sixth lecture series on financial accounting or principles of accounting. And I am your instructor, Jamal Haider. So, we were discussing the adjustment entries in which we talk about the adjustment of prepaid, unearned revenues, right? So, the summary of the adjusting processes. So we have some kind of illustrations here. So we are going through again with some practical examples here. So we are continuing with the Friday's auto service, in which Friday's provide automobile services, and that is the main sales or purpose of the business is to provide auto service. So if the company provides auto services, that will generate its sales. So you can also write down service sales, or you can write it down service revenue. Both are okay. The revenue is more British, USA. In US, we call this sales. Okay, it's just a terminology. That's it. So here we go. Friday's Auto Service Incorporation would make an additional adjusting entry to accrue income tax expense 600 and the related income tax payable as the final adjusting entry for the period. So basically they are just mentioning how they are going to account for the income tax expense. So if income tax occurred but not paid, what would be our entry? Now think about that. Income tax occurred but not paid. So when something is not paid, we create liability, right? It means we will create income tax liability. And now the income tax expense happened. Yes, happened. So income tax expense, when expense happen, always debit. When liability happen, increase in liability, always credit. So what would be our entry then? Income tax expense to income tax payable, right? Any question regarding this entry? Okay, now here we go. So the adjusting process of the company, Friday's Auto Service Incorporation. So here we go. So if prepaid rent expired 1000, this is just a summary we already talked about in our previous lecture. This is just a summary. So it also helped you to recall what we learned in our last lecture. So if prepaid rent expires, it means 1000 worth of rent from prepaid is now consumed. So prepaid rent is our asset. Asset is now decreased to 1000. Asset decrease, credit, right? And this prepaid rent is going to be transferred to income statement as expense, right? So this 1000 has converted into expense. We consumed $1,000 worth of rent. So expense to decrease in asset. Decrease in asset, we have prepaid rent. So entry would be rent expense to prepaid rent. Supplies used 300. So among supplies, among supply stock, we have used or consumed $300 worth of supplies. Simple supply expense to supplies, right? So we take that 300 to the expense. And then depreciation on equipment. So this is the special case in which we don't write like depreciation expense to equipment. Why? Because we need to create a contra account or opposite of the fixed asset or long-term asset. We call this accumulated depreciation, right? So increase in asset would be debited, but the contra account or opposite account of the asset increase mean credit. So entry would be depreciation expense to accumulated depreciation, right? Accrued salaries occurred but not paid. Salary expense to salaries payable, right? Something is not paid, we created liability. Accrued revenue, 300. It means revenue occurred, but we didn't receive. Accrued mean occurred, and revenue, we receive revenue, not pay revenue, we receive revenue. So it means when revenue is not going to be received, then we create a customer. We call this account receivable. The F1 is amount of unearned service revenue that has been earned, 200. It means the customer paid us in advance, and from that advance, we are only entitled to record 200 revenue. So when customer paid us in advance of the revenue, we call this unearned revenue, and that is our liability. So decrease in liability, right, of 200. So decrease in liability would be debited. So answer would be unearned revenue to revenue. Increase in revenue is credited. And the last one is accrued income tax. Tax occurred, right? They didn't say that paid income tax. If paid, then it would be a cash. Since accrued, cash is not involved. So entry would be expense to, which means income tax expense to income tax payable. And that's the ledger account you see. So first one, we make the journal entry, and then we make ledger. After making ledgers, we make trial balance, right? And then we make adjustment. It means the balancing of ledgers is not 100% completed in step 2. Why? Because there are some supplies that are consumed and need to be adjusted for. It means we will be creating some expenses as well. So here we make adjusting entries, and then we make adjusted trial balance. We call it adjusted trial balance, in which we just mention all those adjustments, and then we make income statement. From income statement, we make retained earning. Remember the order. First income statement, and then retained earning statement, and then balance sheet. After balance sheet, we make cash flow statement, right? So you see we have salaries expense here, supplies expenses now closed down. So these are all the adjustment entries, right? The adjusted trial balance, which is made right after posting the adjustments. So it summarizes all accounts and their final balances after all adjustment the end of the entries. So we have unadjusted trial balance, which is made at the third point when we generalize the entry and then post the entry and then balance it out and then post into trial balance. So the sources of the preparation for the financial statement, it means the adjusted trial balance, it is a source for making income statement, balance sheet, and retained earnings statement. So how it is made? So you see here, up till now, we have trial balance, right? And then we have the entries. After entries, when we balance it out, right, ledgers, we have a new one. So these are just the entries, okay? So don't confuse with the adjustments here. Okay, you can put the adjustment here and you can just write down the final balances after. Either you can make the adjustment here, or either you can just go to the ledger side and then rebalance again, right? Like supplies here. Previously there was a 700 balance and then adjustment says 300 is consumed. So you make 300 here, supplies is 400. And now the supplies expense is now 300. So you can create supplies expense, write it down 300 here on the debit side. And on the supplies here, you just write it down adjusted balance 400. Why? Because after the adjustment, you see the balance is 400. So this column is, you can see it is, you can say this, it is just the extra one, or it provides a meaningful information regarding the entries. You can directly post the entries here. Okay, even if you skip that part, the worth of the adjusted trial balance may not won't be decreased, right? So adjusted mean you accounted for all the outstanding, accrued, unearned stuff, and then you have the final verifiable precise account balances which can be served to make the financial statements. So now we have the illustration. Since we are just 6 people, so I'm not going to make you in a breakout room and waste more time. So we are going to do it together. So I want your 100% participation. Okay, everyone? So please participate. So there is illustration of Phoenix Equipment Rentals Company. Remember, they are rental companies. So their main source of revenue would be rental income, right? If they receive rent, so that would be a rent revenue, okay? So generalize the adjusting entry needed at December 31st, 2014 for each situation. The business has interest expense 1200 that it must pay early in 2000 January 2015. And where are you right now? You are at 31st December, right? It means expense occurred but would be paid later. And you are right now standing on 31st of December. So on 31st of December, would you be able to pay? Answer is no. So we create liability. Answer would be interest expense to interest payable. Do I have to explain this? Junpyo, Minsu, Misha, Sipade, Min, Arone?
No.
Okay, let's move forward. And then